Hello, traders, and welcome back to today's daily analysis. For the dollar, today lost some momentum before the weekend, but this doesn't signal a major shift. A recent Treasury sell-off has slightly weakened the dollar as traders reacted to the underwhelming durable goods data. Even so, the dollar index hovered around $104 before close, and both the US macro conditions and political dynamics suggested continued support for the week. Last week, the dollar and US Treasury yields hit 3 month high with the dollar index around 104. Under Trump's low tax, high tariff policies, inflation and debt concerns have driven Treasury yields higher, keeping the dollar strong with a solid 3.4% GDP growth in quarter 3. The strong economy could influence the Fed's rate decisions, though 2 rate cuts are expected by the year end. On the technical side, the dollar index broke above the 200-day moving average at 103.82 last week, hitting a high of 104.57 before pulling back. The index could now consolidate to ease the overbought conditions, with key resistance levels at 104.57 and 104.85. If the dollar breaks above these, it may push towards 105. However, the RSI near overbought levels indicates possible resistance ahead. For support, 103.82 to 103.85 is a key area to watch, potentially limiting the further declines. A drop below this zone could see support at 103.44 and possibly 103.15. And for crude oil, before the weekend, the crude oil prices rose as inventories monitor the Middle East conflict, ceasefire negotiations, and the upcoming US election. The Brent crude climbed 4.09% this week, while the WTI rose 3.97%. WTI futures for December closed at $71.78 per barrel on Friday, with prices holding steady amid talks of the possible US brokered peace efforts involving Israel and Iran, which could impact the oil markets further. Technically, the crude prices struggled to hold above key levels at $71.99 and $72.22 last week. If the ceasefire negotiations advance, oil may face further declines with 70 and 69.78 as initial support levels. A drop could lead to $67.12, last supported in mid 2023, and potentially 64.75, a 2024 low. On the upside, resistance at 71.34 to 71.42 and in 72.89 will be the key areas to reclaim for any rally, with additional hurdles near $75.02. And lastly, for the gold, continued its rally from October's low of $2,603, breaking above 2,750 and reaching a new high at 2,758.50 per ounce. However, the rising US Treasury yields and improved risk sentiment slowed the momentum. This week, the gold's movement may be influenced by the upcoming US GDP and October labor data. Gold began the week stronger, boosted by China's rate cut, which eased recession worries and the safe haven demand following reports of an attack in Israel. After hitting 2,758.50 midweek, gold dipped to 2,708.80, but rebounded to 2,750 before the weekend. On the technical side, the 14-day RSI remains high, showing a bullish momentum. The key support lies at 2726 and 2700, while breaking above the 2747 could renew the uptrend, targeting 2758.50, 2768, and possibly $2,800. And that is all for today's daily analysis. Thank you for watching and have a nice day.